Message out. Sunil Subramaniam joins us. Sunil, good morning. Thank you for joining us. Sunil, suddenly investing in mutual fund is not becoming a very gratifying experience, because if you are buying stocks, your returns on a weekly basis and a daily basis are much greater than what a mutual fund would give you on an annual basis.
Absolutely. That's what you talked about, the Robin Hood investors, right? Coming in, buying everything. I would add to this the fact that ETFs are the ones which have consistency seen flows. So they are buying everything in the market, regardless of what the future outlook is. And third is, of course, that there are a few stocks which are the darling of institutional investors, right? We know the polarized rally. So no mutual fund can afford to be that polarized with its portfolio and that dynamic with its portfolio. You got to understand that mutual funds are trying to deliver wealth based on a fundamental approach to which company will do well over 3 to 5 years, and the market will respect that in the medium term. So I think this short term, these bounce back rallies which is happening, and some of this is a dead cat bounce, like you mentioned about the multiplier in the penny stocks. I don't think it's right for a mutual fund to get worried about it, as long as the quality of the portfolio is consistent. And I'll just point out here one thing, like, if I was just looking at 3 months, you talked about penny stocks. So you look at the BSE small cap index, I think there's a huge number of stocks. It's up 38%. Our fund, small cap fund, which, as you know, at Sundaram, we always believe in buying only quality companies. We are not buying any one of these penny companies. Is up 37%. So it's just 1% less. But yes, it is 1% less than the thing. And so people are saying, what is it? But I'm saying with good quality names, if you're able to get just 1 or 2% less than the market bounce back in a short run, what this will mean is that when the froth in the penny stocks goes away, when people realize what's happened, when the speculators come in, book their profits and walk away, when the actual quarterly numbers come in and they realize they made a bad bet, whatever it be, what will be left will be the good quality companies will get an extra share of flows diverted from these other companies. And over a 3-year, 5-year perspective, as we know, mutual funds do tend to then beat the benchmark. So I would say that, a lot of media channels, not yours, but other media channels are promoting this fact that, direct investing, buy today, sell tomorrow. This is at a 52-week low, that's at a 104-week low, so buy now. So I think that kind of a thought process, right, will fade away over a period of time as fundamentals begin to dominate. And I think that real mutual fund investors, they are not taking out money from mutual funds and putting into direct equities. This is what 200,000 new demat accounts have got opened in this period. This is all kinds of people who are just looking at it and saying, I have time on my hand, I have some money, let me go and play the Satta Bazaar, which they think is the share bazaar. So I think it's a frothy temporary phenomenon. I think the dust will settle and people will realize the value of fundamental stock picking and diversification.
Having said that, how comfortable are you with the markets right now, both in terms of valuations and also in terms of where we are positioned? I mean, long-term investing will only make money when you are when you're investing at a reasonable level. Good companies which are offering you growth visibility are massively outpriced. Companies where there is little growth and little visibility is where the value is. If you buy bad companies where earnings are not there, you will not make returns. If you buy good companies where returns are going to be coming, earnings are going to be coming, they are expensive. Isn't there a conundrum there?
There is, in the way you put it, Nikunj. I agree with that. But you got to remember one thing, right? That is, the good companies in good sectors are the one where there is froth and the valuations are very high. Because the sectoral outlook is good and they are solid players there. There's no harm in that. And that's a price and a premium for quality which is being demonstrated. And those stocks in those sectors will not deliver you great returns, but they will give you decent, double-digit returns. But the real value, when you ask me from this, is that the very fact this is a very polarized rally means that there are a lot of good companies in sectors whose future outlook right now is not looking great. But if you just shift your lens to 18 to 36 to 60 months, you know that these sectors are critical for India. And the good companies there, unfortunately, because of this whole sector outlook, are not getting that kind of a flows and their valuations are not that up. So on a broader market basis, I still believe that there is good value from a 3 to 5 year perspective to get phenomenal returns from the market. I think if you're going to chase the good in the good sector, right? I think that's where. I'm not saying chase good in the bad sector, but in those sectors which are cyclical, which we know that we know that end of the day, Nikunj, the COVID crisis is not going to last for, let's say, 3 years, right? Whatever said and done, it's going to be cracked in, let's say, a year's time or maybe a year and a half's time. But the core business of people going about their work, consuming stuff, factories being built, I think that factor is not actually coming through in the valuations, because you see a sharp sectoral polarization in the valuation. So good companies in good sectors are the ones trading at high valuations, but I think there are a lot of good companies in the cyclical and those sectors which will definitely do well in the long run, where there is a good value pick. And I think that's what we are looking at in terms of our GARP approach, right? Growth at reasonable prices. So I think that's another reason why in the short term mutual funds are not tending to outperform, is because these very good companies in good sectors have gone up so much in valuation that they are also exceeding a normal place in the index. They have got an outsized place in the index, and mutual funds, by their own risk management, by the regulations, are limited to taking not more than 10% of a particular company in a portfolio. So I think these are the factors which are at play. And I think that one more point here, Nikunj, is that ultimately, if you look at it, let's look at a 18-month lens. I will say that of all the world economies, the Indian economy is going to be the biggest winner in a post-COVID world. And that's what your FII flows, if you look at FII flows into emerging markets, every single one is negative, calendar year to date, financial year to date. India is the only one positive, calendar year to date, financial year to date. So there is something that the foreigners see in India, right, which is good about India. That's because I believe that by in another 2, 3 or 4 years, 2024, India will be the third largest economy in the world by GDP, following on the China and then the US. So I think this factor is an underlying factor for a positive approach on a 3 to 5 year basis. And when you talked about valuations, yes, if you're going to look at trailing 12-month PE, yes, they look rich. If you look at forward for the current year, March 21, they look rich. But you just extend it back by a year. And your guess and my guess, let's put it on. Like, I think that India is going to be at a 7 to 8% GDP growth in 21-22. Now, the IMF says it's going to be at 6%. Now, some other person say it won't be 6.4. Whatever it be, FY 21-22 earnings, right, for the Nifty are, I think, current market analyst prediction is about 650, right? So on that perspective, I don't think the valuations at about 16.5, 17x are not expensive. And in fact, broader market, mid caps is about, and small caps are trading about 14x for a FY22. So your perspective in time frame on when you're putting your money in today, over what period you hope to make money, I think as long as it's beyond FY22, which is March 22 and beyond, I think you're in a good space on valuations. It's the 1 year investor that I'm worried about. It's the 6 month investor that I'm worried about. Short term, there are challenges. There is the US elections and the related uncertainty which will come to the market. So let's leave the next 1 year out of the picture. So on valuations also, I believe that this is an excellent time to take a 3 to 5 year outlook and maintain a balanced portfolio. Because generally, when the economy recovers, Nikunj, the mid and small caps do well. So in 3 to 5 years, definitely they should do well. But I can't say large caps will not do well because liquidity, FII's view, FDI coming to India, on the back of it, FII flows coming to India on a longer term India bet, I think will sustain right through this value chain, right through the period. So I think that it's good to have a balanced portfolio of large, mid and small in this period, and you will make healthy returns from a 3 to 5 year perspective. So I think valuations wise, I'm not so worried as long as that lens is applied.
Sunil, you've consistently been optimistic, and have been bullish on the kind of opportunity there. But what's new, perhaps more recently, given the pace or the momentum with which we've seen this rally in terms of perhaps stocks, preferred plays that you've changed, picked up at a time like this, or even those that you've exited with some profit booking?
Well, okay. So the one where two places where we have changed our view and both towards the positive. So I've been on this channel for a long time. I was bearish on pharma and healthcare. Though domestic healthcare, I was always bullish. Pharma overall as a sector, we were not bearish. I think over the last few months, since the correction in the market in March, since the whole importance of a medical story because of this epidemic to the whole scenario, I think we are happy to have changed our view to a positive to pharma for the next foreseeable future. So let's say a 2-year time frame, yes, we are positive. So that's one where we have taken on additional weights and that. The second one, right, in the run-up to the March, we were actually not so bullish on IT. We felt that IT was, linked to the world being on a slightly slowdown. IT business would be in a slowdown and all that. But I think what the crisis has again done there is reset the fundamentals of IT. It created the Y2K opportunity for IT, where this whole work from home, the huge data consumption at home, the whole digitalization of the world, so the Internet of Things, the cloud computing, I think have changed the business model for IT, and there's another leg up now. So we've changed fairly positive on IT from a neutral standpoint that we had earlier. So these are the two positive changes. Where have we paired our portfolios and booked profits? Well, banks. We continue to retain a long-term positive on banks, but the way the market valuations have corrected because of this fear of NPAs during the crisis and post what's going to happen has had a bearing on valuations. Now, our fundamental view on banks over a medium term hasn't changed, but in the short term, we have, because if I have to buy pharma and IT, I have to sell something. So that's one space where we have paired our portfolios, but we continue to be reasonably weighty there. I'm underweight the index, but reasonably weighty. The other place where we again took a profit pairing kind of a thought process was on the consumer discretionary, consumer durables, auto. So those which were like on a rate sensitive, plus there was this summer which was supposed to be very good for consumer durables. We know that summer wasn't that great, and auto, while it's now recovering very fast on the back of rural demand and on the back of last year being very bad, we believe that for auto really to pick up, we are in neutral from. We were very bullish and we've turned to neutral. So some amount of pairing the portfolio in auto, the recent rise has helped us to do that. So, but we retain again both the consumer durables, the banks and the auto where we are paired. Let me tell you that our medium-term outlook remains positive, but because we have to manage our portfolios on a daily comparison with the benchmark and with the market, this kind of a balanced approach is what is playing out in our portfolios, right? So on the whole, I would not say that from a 3 to 5 year perspective, I'm bearish on anything in India. I think that, like I said, India, I believe, is going to be the biggest gainer in a post-COVID world.
Okay. We've talked about banks. What about NBFCs, and particularly the mid-cap NBFCs as well, Sunil?
So I think good you asked me about the mid-cap. I think mid-cap NBFCs, we are still neutral-ish. We are not yet very seeing who the winners are. I think the large cap, the bigger of the mid-cap NBFCs, large cap NBFCs, we believe will the survivors. And I think NBFC lending is a key to economic recovery because they can reach spaces where the banks can't reach, right? So I think that they are critical for India's recovery. I think there'll be a lot of actions which you will see from the RBI and the bankers in the coming weeks and months, which will support that sector. I think ever since the IL&FS crisis, that sector has been on a back foot, so to speak. So I believe that tide will change, but it's still early days. I still think that financing for them, because I think the mutual fund sector, the debt mutual fund sector, lending to mid-cap or smaller NBFCs, I think is pretty much the tap is dry. I don't think anybody is taking that risk. So a big funding source for NBFCs has gone missing. Right? NBFCs, mid-cap NBFCs still can't go and reach direct investors from a deposit or a NCD perspective. So they are dependent on financing from the banking system. And I think the banking system itself is slowly coming out of its negativity on that sector and started lending there. But again, there is still a polarization towards the bigger ones.
Sunil, but Sunil, Nikunj and I were just chatting about the way some of the penny stocks are moving. I mean, call it an impact of the Robin Hood traders jumping on the bandwagon or what have you. But this is an alarming sign. Would you be a little worried about what's happening in the smaller cluster, in the penny group, in the 2-digit, single-digit penny names? Because typically this is, this is the last cluster to always move up, almost calling a top for the market.
Actually speaking, there are two perspectives that I want to bring here. So as Nikunj pointed out a few minutes earlier, these rise in the penny stocks is making mutual funds look bad in the short run rally, because no mutual fund is got any significant exposure to any of these penny stocks. So yes, the investor, from an investor perspective, will say, what is this? Why is my mutual fund not beating it? So there is a small negative there. But otherwise, as a market participants, this is a very welcome thing. Why? Because these Robinhood investors are providing depth to the market. You go back to the years of Badla financing, right? So it's like you need investors, long-term investors, you need short to medium-term investors, you need speculators, you need technical traders in the market. That is where liquidity comes in. So today, let us say that a mutual fund 3 years ago had bought a stock which they felt was good. But the ongoing sectoral, whatever reality has now made that a penny stock, let us say. Now this liquidity that's come has helped that mutual fund to exit that stock at a reasonable price. So what I'm trying to say is that in the mid and small cap segment, liquidity is a very key factor for the market. And these speculators, penny stock investors, Robin, whatever you call it, from a market perspective, they are a part of the market, they are a healthy part of the market, they provide the liquidity that goes around. Now, second part of it. Now, in this, there are technical traders who are dadas at it, who've been at it for years, who come in, short it, take, buy, sell in 2 days, sell in 3 days, sell in a month. They are there. But there are a lot of these new investors who've come in, who have seen this kind of a rally, some recommendation from some channel, some recommendation from stockbroker saying, buy this is at a 52-week low. And he's made money and he's happy. He's the first time, like I said, 200,000 plus demat accounts have been opened. Now just imagine that investor, right? He has come into the stock market at the riskiest end of the market. Sometime or other he's going to burn his fingers. That's when he'll realize the value of fundamentals, of stock diversification, of mutual fund. So for me, all of these new investors coming in represent a huge potential investor base who ultimately, having burnt their fingers in direct stock, will come to realize that a mutual fund is value. So I think mutual fund penetration in India has a long way to go. And if this is one mechanism by which it increases, I'm happy for it. So overall, I think we've got to remember that the market always has a varied set of participants. And while we are looking at it and advising investors not to do this, but anyway, there are people doing this, that's a part of the depth of the market. And you will find that in any market, in the US, in Europe, in Singapore, Hong Kong, anywhere, you'll always find people with a gambling instinct who would like to come there and punt on the market. You can't prevent it, but they are an essential component of liquidity, right? For every buy, there has to be a sell. Every sell, there has to be a buy. That
Sure.
These people provide that to the
Sunil,
market.
I'm running out of time. I have to take a commercial break. Apologies for the same, but great to have you on the show and get in your insights. We're going to take a very quick break, come right back. A very interesting discussion with ICICI Lombard Management coming up.